I have this thinking framework that would be I haven't shared with anybody yet. So you'll be the first to, I'll be sharing this. So we basically have two timelines right now. We have a timeline that is set by the virus, right? How long we're going to be in the lockdown. And then we have another timeline, kind of the consequences the virus has on the economy. Two different timelines. At some point, the virus timeline will stop and the other one will kind of dominate. So today we are still kind of focused on the virus timeline. But let's say hypothetically, a month from now, I'm just making this up, but let's say a month from now, we come out of a lockdown. So then the second timeline becomes a lot more important. And I'll give you this analogy. So today you're not traveling because you can't, because you are locked in the home. Tomorrow you may or may not be traveling because of you're afraid. And day after tomorrow you may or may not be traveling because you may not have money to travel. So these are three different, we need to figure out how long today will last, how long tomorrow will last, and how long the day after tomorrow will last. Those are three different timelines. So, and if you start looking at company analysis from this perspective, then it actually makes analysis it provides you framework at least. Okay, so if you look at it, let me give you two extreme companies. Let's say on one spectrum, you have a healthcare company, pharmaceutical company. So it's not really impacted by what you're doing today or tomorrow, day after tomorrow. Okay. On the other extreme, you have a company like, let's say, I'm going to give you an extreme example. Let's say it's a hotel in Venice. Okay. So we know that hotel in Venice is going to be, today it's empty. Tomorrow it's going to be maybe, if normally it has 100 people there every day, maybe tomorrow it's going to have one. Okay, or two. And then over time, it's going to get filled up, but it's going to take a while before it gets to 100 people capacity, okay? And so it's really the question is, so today we are on a virus timeline, and so that's why it's empty. And then, and then after a while, it's going to start filling up. But again, it's impacted by the factors that are basically how much fear we have and what economic impact of this fear. So this, so you have the hotel in Venice, and then you have Pfizer or whatever, By the way, we do own Pfizer, so I just, Okay, so for your full disclosure. So, and so when I analyze companies, I kind of try to figure out where do they fall on this, scale. Is it closer to pharmaceutical company and so far, what we try to do, we try to stick closer to the to the left scale, to the companies that are impacted the least. So we know that the consumption of their product is not going to change that much. Okay, but also we've been we've been looking at companies that are they're going to be impacted for a long time. Okay, but when we buy those companies, we would have to have a discount to their fair value. Very significant discount because we are taking a lot more uncertainty risk. Okay, and so the problem is when you look at the companies that will be impacted the most, your analysis has to be also very different because you have to start thinking about liquidity. Like Pfizer's cash flows are not going to change that much, right? So I may not necessarily need to spend that much time analyzing its balance sheet. Because, maybe the cash flows decline a few percentage points, makes no difference for them. But if you look at the, hotel in Venice, hypothetically, then you really have to look not just at its liquidity. You have to look how much cash it has in the balance sheet, what are the credit lines, what are the maturities of debt it has, okay? And then you have to start looking at fixed costs. So the analysis between Pfizer and hotel in Venice is going to be completely different. And so most of our portfolio today is kind of tilted towards kind of the Pfizers of the world. Okay. But we also, we are trying to, we dipped a little bit into the kind of the hotels in Venice, kind of type of companies. So that's kind of my thinking framework, how I look at companies today, and that's basically it.
So for the Hotel of Venice kind of company,
Mm-hmm.
it's not really enough for you to have a general balance sheet. You actually need to get in the detail of the liabilities, understand everything that surrounds it, like credit lines and everything.
Yeah,
so first to establish if it's going to survive,
mm-hmm.
and then how it will, a potential path for it to emerge from this.
That's right. And also I look at everything, the kind of AC and BC, kind of before coronavirus and after coronavirus. So it's almost like a, what's interesting in January, market would be concerned about having a recession. And recession is basically when you have expansion in the market, the economy is growing, let's say 2 or 3% real growth. Okay. And in the recession, it's declined, 2 or 3%. Okay, so we were concerned about the 2%, 2 or 3% decline. While today our economies are shrunk by 30% overnight. Okay, and today we would be begging for 2 or 3% decline in the economy. So we're kind of begging for just a normal recession. So if you take, let's say you index January global economy at 100. Today we are at 70. Some of the industries, the Pfizer is probably still at 100, but the hotel in Venice is at 0, basically. So so the way we look at it, that when we come back to normal, to general level, some companies may not get to that level for a long, long time. Okay, so I'll give you an example, like let's say restaurants. So when we come out of lockdown, the restaurants will resume. But instead of having like 90% occupancy, there will be starts at 20 or 30, and then gradually start going up, right? So when you analyze companies like this, or like the hotels in Venice, as we talked about, you basically assume that it's going to take a long, long time for them to get to the kind of semi-normal levels, but what we are accustomed to. So therefore, the earnings power would be lower, and therefore, this is why it's not like for these companies, you can't really look back what their sales were over the last couple of years and say, this is my baseline. I think this baseline has to be reset. And I think reset dramatically. So if you have a company like Booking, for instance, which we own a tiny bit, it's a phenomenal company, but most of its business is in Europe. This generates a huge amount of earnings from Europe. And I would argue that the earnings it had in a BC era are going to be very different from the earnings it had after after lockdown is over, are going to be substantially lower for an extended period of time before they get to the kind of BC era again.
So they basically they went down in value, and given a margin of safety, part of that is they really lost that value period.
Well, it's not forever, but let's say it may take him, I don't know, and right now my guess is as good as anybody else's, but it may take him 2 or 3, I don't know, maybe 1 or 2 or 3 years to come back to par. Just because,
okay.
Let's clarify this a little bit more. So at first, people will be traveling to Europe because they have to. So if I have a meeting in Europe, I have to travel, I'll do this. Okay, so then some people will start traveling to Europe for vacations, but again, more kind of brave people, because because you still have a lot of fear, right? And then over time it will go up. However, by people doing less travel to Europe, that means some of those hotels will go out of business. And you're going to have, and basically what's going to happen, I think we're going to have a structurally high unemployment for a while. Just because if your hotel is, 20, 30% occupied, you probably don't need as many people to clean those rooms. So it's, and there's consequences for that, right? So therefore, I think it's we are basically going from kind of a depression today to recession. And it's very hard to say for me how long it would take us to get to kind of a normal level. But it's not like, when the virus is over, we're not going to come back to par. Like Pfizer is not going to change much. Canton and Venice is going to be impacted, and it's impacted dramatically for a while. One factor that's kind of different this time is that we never had so much stimulus coming from governments. So and it's very difficult to kind of estimate which one offsets another, right? Because government is literally throwing money at people today just to make sure we don't have a depression. So we kind of have if you think about it, we do have a depression in the sense, if you look at, our GDP probably declined 30%. Okay, but at the same time, people don't feel that because they are still, the government is trying to throw so much money at people. And so when the economy restarts, they restart, you can't really control the fear part of the economy, right? But they want to make sure that when Boeing starts manufacturing planes, it can bring people very quickly to do this, etc. So it's a very kind of odd environment we're living in today. So,
Vitaliy, I know your fund or funds are in very good positions. So I would like to ask for your advice in two hypothetical situations. The first one is easier than the second. The first one would be, if there's an investor out there who's all cash today, what do they do?
So, okay, I'll tell you what I'm doing. And so I'm not going to, okay. So when we went into the crisis, we had plenty of cash, and we had some hedges on the indices. And what we've been doing throughout all this, we've been basically analyzing one company at a time and figuring out how much we want to own each company. And we've been buying a little bit at a time. I call it microdosing, which is probably, I want this term to be on my gravestone. This is a value investor who microdosed. What we basically were doing, we were just buying small positions of a lot of different companies, just kind of to diversify our ignorance a little bit, because we are all ignorant in this situation, because we've never seen anything like this before. But we've been, so my advice if you are sitting on cash, start analyzing companies and try to figure out, are you looking at the Pfizer's? Is that closer to Pfizer? Is it closer to Canton Venice? Or where does it lie in the spectrum? And therefore your analysis is going to be a little bit different. And then figure out, okay, well, based on where it lies in the spectrum, you're going to need to estimate the earnings power. In the case of Pfizer, I don't have to reduce the earnings power very much. In the case of Canton Venice, I probably have to have a much larger margin of safety, and just invest one company at a time, and look at these companies as you would own businesses, not just kind of stocks that are, not just kind of pieces of paper or digital bits that you could buy on the stock exchange. And just build a portfolio once, basically kind of one stock at a time. That's how I would do it.
Let me zoom in a little thing you said that, which is, I think, mighty important, which is look at these stocks as if they're businesses, as if you want to own the business, not as if they're pieces of paper.
Yes.
What's the difference?
Well, so it's kind of interesting. So the stock market has this, because you can buy and sell with such an ease, right? And you can do it daily basis. It's very easy for the stock market to become basically kind of almost like a Las Vegas for you, or kind of a casino for you, where you justify just because something is called Microsoft and you're buying and selling it every day. You say, I'm an investor. Well, if you're trading Microsoft 5 times a day, you might, you are really not an investor, you are a trader, or you're basically a gambler to some degree. Okay. If you start analyzing if you approach Microsoft as if you were buying the whole business, suddenly your analysis changes. Okay. And actually the Warren Buffett has this saying, okay, well, how would you analyze Microsoft if you could buy it and the day after the stock market was closed for 10 years? Your analysis would be very different. Okay. And I think if you have this attitude, okay, I'm buying this company and I won't be able to sell it for 10 years, then suddenly the casino kind of fades away, and the kind of your attitude as a business owner comes in. And that's a very, very different approach. It's a very different approach, very different attitude. And that's basically, what investors do. That's how value investors or investors, that's how they should be analyzing businesses.
Fantastic, Vitaliy. Really, really enjoyed this.